It was a cold January morning in 2021 when something extraordinary began to unfold. GameStop, a once big video game retailer whose stores were getting quieter by the quarter, was trading at around $20 a share. At the same time, a handful of powerful hedge funds had made a bold bet. They were convinced GameStop's downward slide would continue, so they sold heavily. They were certain of victory. What they didn't count on was an army of retail traders on a Reddit forum, armed not with insider tips, but with memes, mobile apps, and a sense of let's show them. On the subreddit WallStreetBets, users share tips, screenshots of outrageous gains or losses, and random memes and jokes. One user, known only as DeepFuckingValue, posted a simple screenshot of his GameStop position and a few lines of text. He pointed out that the short interest on GameStop had somehow exceeded 100% of its available shares. In plain English, hedge funds had borrowed every share and more, betting the price would fall. But what if the opposite happened? His post invited curiosity. Replies flowed in. If we all buy and hold, they will go under. A mission statement formed: turn a beaten down stock into a short squeeze so painful it would leave those hedge funds bleeding. The idea felt daring, like David against Goliath. Within days, that first post went more viral everybody could imagine. Memes of profits and drowning funds filled the thread. Influencers on YouTube noticed and posted buy alerts. And it wasn't just talk. Thousands of small traders clicked buy on apps like Robinhood and Webull. By January 13th, GameStop closed around $20. A week later, it had more than doubled to over $50. Newcomers cheered each green candle on the chart, sharing screenshots. Just turned $2,000 into $10,000. They felt part of something bigger, an uprising of retail traders against Wall Street. On January 25th, GameStop shattered $100. The next day, it broke $200. By January 27th and 28th, in the space of hours, it rocketed toward $500. Trading volume exploded, suddenly matching giants like Apple. Picture this. You wake up, check your phone, and see a stake you placed on a stock gone from $5,000 to $75,000 overnight. You celebrate with friends on Discord. You imagine paying off student loans, quitting jobs, or finally launching that side hustle. The momentum felt unstoppable. But at the height of it, something unexpected happened. Robinhood and other brokerages suddenly blocked new GameStop purchases, letting users only sell but not buy. The reaction was immediate: outrage, conspiracy theories, and the sense that the system had slammed the door just as retail traders were winning. A quick break to thank our sponsor who makes these videos possible. If you don't want to be left behind by today's fast-moving markets, meet the Alchemist. It's a plug-and-play trading robot for MetaTrader 4 that runs 100% on autopilot. Just connect it to your broker of choice and let it scan currency pairs for high-probability setups. Powered by thousands of lines of code, users can enjoy hands-free returns of 2 to 5% per month, with full control over every trade and round-the-clock support. Click the link in the description to get your automated trading software and use code WallStreet at checkout for 10% off any plan. Now let's get back to this incredible story of retail traders versus Wall Street. Accusations flew. Did brokerages protect hedge funds? Did they freeze out retail traders? Social media lit up with demands for explanations. Even Congress got involved, calling CEOs to testify under oath. On Capitol Hill, lawmakers grilled Robinhood's founder, asking whether the platform had treated its own customers fairly or prioritized big money interests. During the chaos, trading resumed, but the magic had faded. When new buying restrictions lifted, GameStop tumbled back below $100. Volatility remained high, but the wild ride of January gave way to sharp swings and caution. Let's talk about the outcomes. A small group of early buyers who held through the peak walked away with 6 or 7 figure gains. Some netted over $1 million on positions they'd funded with just a few thousand. Their stories flooded WallStreetBets. Paid off my mortgage, college tuition covered, but not everyone got lucky. Traders who piled in near $483 on January 28th and watched prices crash faced losses of 70% to 80%, or even margin calls.
Things in terms of being happy, and then a lot of very depressing moments.
I saw the numbers go up by the numbers I'd never seen them before in my bank account and go down.
On the other side, hedge funds lost an estimated $20 billion fighting the squeeze. Melvin Capital, the largest casualty, lost almost 40% of its assets and needed a $2.75 billion bailout from Citadel and Point72. So, what can we learn? First, markets are emotional. A shared story, fueled by memes and community, can drive prices far beyond any company's fundamentals. Second, timing is everything. Riding a rocket ship can feel incredible until gravity takes hold. And third, platforms can change the rules mid-game, like Robinhood and other brokers did. Finally, this saga showed the power of collective action. Standing alone, one small trader can't change the price. Together, millions of them move markets. But momentum can evaporate as fast as it builds. GameStop saga was more than a market anomaly. It was a story of David versus Goliath, of community versus capital, and of the modern retail trader's newfound muscle. It reminded us that in today's interconnected world, any of us can make history with a few clicks. But remember that same power demands respect for the risks involved. If you're tempted by the next viral stock, remember this tale. The thrill of victory is real, but so is the danger of a sudden fall. Trade smart, size your bets wisely, and keep your eyes open. Because in the market, the line between triumph and disaster can be as thin as a single tick on a chart. Thanks for watching, and until then, I will see you in the next one.